Welcome to Giving You More Than Numbers, the CAS Business Support Podcast. We're back for season 2 and we're kicking off with an episode every business owner needs. I'm your host, Paul Barnes, and today we're talking about the numbers that actually matter, not just for tax, but for running your business day to day. Let me ask you this. Have you ever looked at your accounts and thought, I know I made a profit, but I still don't know how my business is really doing? Most business owners get numbers, but not clarity. Today, we're stripping it back to plain English, the key metrics, the warnings your accounts are giving you, and how to use the numbers to make decisions, not just tick boxes. I'm joined by Jacquie Hale. Hi, Jacquie. Hi. Business coach and profit consultant from Vector Business Coaching, and Andy Horvath, founder of Horvath Accountants. And not forgetting Lottie, our little office wellbeing manager, who, as you can see, is completely chilled. Together, we're all going to help you feel more confident and more in control and a lot less intimidated by your numbers. So welcome both.
Thank you.
It is probably the one podcast, if you don't listen to any other during this series, this is the one that is going to help you take your business in the right direction in the most sustainable way. So it's actually primarily all about understanding those numbers that as a business owner you ignore, but you really shouldn't. So ultimately, I suppose we're going to deal with that. When a business owner says, I just want to know how I'm doing, where do they look first? So Andy, let's put the accountant hat on first, and actually what numbers should a business owner look at? And let's go high level first.
I'll just go backtrack a little, Paul, on that because I think owners need to be aware of the type of business, that whether they're a sole trader, partnership, limited company. Again, you've got different sets of accounts and layouts. And really with accounts, there's the main aspects are the profit and loss and the balance sheet. I am aware some people are not aware of the difference, but the profit and loss is really your trading account that is over a period of time, and your balance sheet is your list of assets and liabilities at a particular point in time. Once people are aware of that, profit is the main source that everybody asks. One of the questions, well, two questions we normally get asked is, what's my profit? What tax do I have to pay?
The usual two.
But I think the third one that is critical is cash flow or cash balance, your cash and bank balance, because you may be profitable, but you may not have enough money to continue to trade.
And we'll touch upon that a little bit later in the podcast.
Indeed. But with going back to figures again, it's really, are you profitable and have you got a surplus on the balance sheet?
Okay. So obviously, Jacquie, you go in and you help businesses understand where and how does that profit come from. So if we now think about, well, I've got a bottom line profit, and to use Andy's point, how much tax am I going to pay on that? But actually, what 3 to 5 numbers should a business owner then understand to know that they're going to achieve that bottom line profit?
Yeah, well, I think I'm gonna disappoint you. I think there are 7 key numbers actually, and I think the 7 key numbers, the first and most important one is the profit.
Yep.
Because at the end of the day, all of us went into business to make a profit.
Yep.
None of us wants to be, scratching around for money. And as Andy said, cash flow is king with that. But actually, for the numbers that a business owner needs to understand, profit is one.
Yeah.
The average transactional value of a customer is really, really important.
Yeah.
Because that very quickly tells you if you're charging too much, too little, or whatever.
Yeah.
The number of customers you have in your business.
Yeah.
That's really, really key as well. Your margin, your gross margin, how much you're actually making. So every time you sell something, you sell a chair for £100. If you've got to pay £60 for the chair, another £10 for the marketing, and another £10 for delivery, we've got 20 quid left.
Yeah.
Your margin, all you've got left is 20%. And that's got to be part of your profit. It's got to pay your overheads. There's lots more around that. And most people don't think about that.
Yeah.
They don't realise how important the gross margin is. I can't remember how many I've done.
3. I'm keeping track.
So yeah, ATV, the number of customers, your profit, your gross margin. Obviously, your turnover.
Yeah.
You need to keep an eye on your turnover, because obviously that's the number that tells you how much business has come in.
Yeah.
The cost of your sales, I just used the chair example,
Yeah.
the cost of sales for every single thing that you do
Yeah.
is really important as well. And these numbers aren't always the numbers that are on your in your profit and loss. You'd have to find them a little bit.
bit of digging,
but
yeah.
as a business owner, you, as I'm sure you'll talk about in future podcasts, you don't need to understand everything that the guys like Andy and yourself do. What you need to understand are the things that are making your business go forward. The things like, how many customers have I got? What are they paying me? Have I got enough turnover?
Yeah.
What's it costing me to run my business?
Yeah.
And that's the other one, is the overheads.
Yeah.
Because all of that money that comes in, unfortunately, we start with the turnover and we take everything off, and we're left with the dribble of profit at the bottom. And what you have to do as a business owner is put that profit first.
Yeah.
So what do I need? What's my goal? How much do I want? So, sorry, that was a bit of a long answer.
No, it's
but
okay.
I think
There's a
really
common thing,
important.
isn't there? There's a common theme that all accountants will refer to: business coaches, profit specialists, whatever terminology, anyone connected in business. Turnover is vanity, profit is
sanity.
the sanity.
Absolutely.
And so you've touched on sort of that turnover piece, and how do we get to that turnover piece with no number of customers, cost per customer for both average transaction value, but also those acquisition costs and all of those bits. Mm-hmm. But why do turnover and profit, and I'm going to hit this at Andy first, and please chip in, why do turnover and profit read separately give a full sense of security to a business owner?
One would always say, Paul, that with a profit, you're doing well because you've made a good profit.
Yeah.
It really depends on the industry you're in, because you can make good profits, but your cash flow can be awful.
Yeah.
And with that, it could be upfront costs or upfront payments you have to make before you realise that profit. And in cases, yes, you're making profit, but there's other expenses in there that don't relate to cash, like the depreciation.
Yeah.
And it's making people aware that, you know, as Jackie said initially, that cash is king.
Yeah.
And it's all that is your number one. Profitability normally is in line that if you're profitable, your bank balance is good. But in some instances, it's not the case.
Yeah. Anything extra to add around that, why turnover and profit read independently, giving a full sense of security?
Yeah, because I think you're right. People are, oh yeah, I turned over 500,000, I turned over $1 million.
Yeah.
But if you're spending £499,000, that's
well, you're on a rescue mission as an accountant, as a business advisor.
Absolutely, and they're both really important numbers, aren't they? But actually, the profit margin is the key.
Yeah.
Because if the bigger that is, the better you're doing ultimately, isn't it?
And sorry, Paul.
Yeah, no.
I had a client and they had $1 million turnover and made marginal profit. We went through that, discussed it, and said you need to look at reducing your turnover, because you're not making your margin. Get your margin right. Mm-hmm. And with a lower turnover, they made double their profit.
That's it. And I think that's that piece about what you were saying, Jackie, about understanding what your customers give you and what the costs are against that customer, because you could have two divisions inside your business. One of them is making something from scratch and one is just buying it and selling it. But the one making it from scratch, that is your bigger turnover, is actually costing you money. But the item that you just buy in and put a margin on and sell out the other door is actually making huge profit, and one masks the other. So taking your profit in half, your turnover in half, but actually is going to double your profit. It's that insight that people really do need to understand.
You're 100% right there. I worked with a fantastic website and graphic design business a couple of years ago, and it wasn't until they dug into their numbers they realised there was a whole branch of their business that was losing money, and that was the graphic design, the banners, the printing, the business cards, which they thought they were overcharging as it was. They thought they were getting good prices for them, but what they realised, actually, the amount of time that their very highly skilled staff were using to make those designs was just not getting paid for in the same way if they sold a website. So they stopped promoting it. They didn't stop doing it, but they stopped promoting it, and they started promoting the stuff that got the much
bigger margin.
And their profits that year just massive, like you said, massively doubled. The turnover wasn't much different, but the profit was way, way different.
Yeah, and I think that's that thing of when you're in business and you've got all of these different products, and you see that turnover figure without understanding where is that derived from, and you see that profit, but which part is giving me the profit. That's the piece that I think business owners ultimately fall down on.
And also it's the part where you can make savings. So if you've got a part of your business that's not very profitable, then you need to really question your business and go, well, what is it that's costing me? Is it because I'm sending too many staff on that job, for example, or because I could find a better supplier that would do me a better deal? And that's where, as a business owner, when you're working on your business, that's the £1,000 an hour work. Because by spending that time looking at your numbers properly with or without an accountant, but probably with an accountant to begin with, so you can properly understand where a 5% saving on that cost might actually make a huge difference to your profits.
That's it. I mean, we talk about it when we work with clients, and I know Andy does the same. We talk about unit economics. So it's that cost per unit, because that's really key.
Paul, I've got a client, two things, engineering, and they got an order from a customer. And we drilled down through the figures, and we found that it was cheaper for them to subcontract out than do it themselves. So that's where figures or numbers are really important. And the other same client again, they had a designer, and they weren't charging his time. So in there we built in a time in there, and the profits went up again.
It's perfect. So I suppose to just round out the first part is almost that turnover versus profit. If you read them independently, you're basically on a slippery slope. To read them together but understand how those numbers are arrived at will give people far more insight into their business. So if we then move on to, and it was alluded to earlier on, cash versus profit. Jackie, I'm going to hit this at you because, and Andy, forgive me, you and I are accountants. We are very much going to speak a slightly different, more techie language. So let's ask Jackie, in plain English, what is the difference between cash and profit?
Well, cash and cash flow are really important, because if you've got good cash flow, it means you can make decisions. When you're strapped for cash, when there's nothing physically in your bank account, it doesn't actually matter what the profit is on your accounts, on your P&L, because you can't spend, and that diminishes your business. It diminishes your choices. One of the things I really battle with business owners with very often, especially trades, is they won't change their Andy's laughing. Is they won't change their model of pricing. Now, I'm very fortunate. My first business that I built was a cash rich business, not because we had more cash, but because people paid us up front. You never deliver TP for a wedding unless it's been paid for a month, 6 weeks in advance. So that money's already in the bank. And I know that's a really fortunate place to be. But what I cannot believe is how many businesses don't take any form of deposit. They're often paying out to their labourers, they're paying out to their suppliers. They might have an account at Selco or Screwfix or whatever it is, but that gets paid before they've been paid by their customer. And that's absolutely not the right way to be. Cash flow is massively, massively important. However, there is a caveat with that. Just because your bank balance is looking really good doesn't mean you can go and spend it. And again, I really try and berate the business owners who look at their bank balance every 5 minutes, because that is not giving you a true picture of your business at all. That just tells you what's in the bank today. It's a bit like an MOT. It's valid for that day, but 2 weeks down the line, your tyre can blow. It's really, really important that you always have the bigger picture.
Yeah, perfect. So Andy, let's get a bit technical then, just to wrap that back round. In accounting arenas, the difference between cash and profit can often dictate what, I guess?
Oh, that's a good question. Because the thing is, people, as I stated previously, if you're profitable, they always assume that your cash reflects that profitability. But we know in certain instances that is not the case. Profit is, as we say, a trade. It's just a picture of time how you've traded during a period of time.
So basically, that's how much I'm going to use the phrase invoiced and spent rather than received and spent, because again, that's where we cross over.
Where again, you see with cash, that's where you got the differences. You received it and you spent it.
Yeah.
We can say, I'm sure Jackie is the same. We can see with clients that they spend the money before they receive it. And I know exactly, again, with my engineering client, their customers don't pay till 60 days after the invoice. Their normal supplier terms are 30. So what we've done is eke that out a bit to 45 and then hopefully to 60. But normally suppliers are 30 days, it's getting that balance right.
So that difference between cash and profit, in essence, is all about how quick I can turn my trading activity into money in my bank.
And sorry, Paul, the classic there again is you may have invoiced for sales that will increase your profit, but then you don't get paid 30 days later, so it doesn't reflect.
And I think that kind of then answers one of the questions I really wanted to get out for the people that have tuned in, is why can a profitable business still be under major pressure? And I think you've already alluded to one, debtor days, i.e. the time it takes to get paid. But what other things do you see when you go and work with businesses, whether it's on a recovery basis or to just try and help them get better insights, other than that magic debtor days, what other things put businesses under pressure?
I think the biggest for me is seasonality. So obviously, as I say, I came from the wedding industry. Travel industry is also the same. Even hairdressers are the same. They have a mad December. They do really well.
To look nice for Christmas.
Yeah, and then January, nobody's having their hair done. Nobody's having their nails done. For us, we had a drought from October through to March with no income. I knew that in the summer I had to build my banks of reserves to pay my 30 grand a month of overheads throughout the winter. And too many business owners, they just make hay while the sun shines and forget that actually there are down times. And one of the things that I try and build with my clients is to get them to a point where they've got at least 3 months worth of break-even money, so the business can wash its face, as we call it, for 3 months if something were to go wrong. If they lost a contract or if a key member of staff left, you've got to have that contingency. And I think the people who struggle are the ones who are just living in the moment and not looking at the insights and not planning for the future and not budgeting. And all those things make such a huge difference. And that's the difference between, let's be truthful, being a professional business owner and being a business owner. And professional business owners, they care about accounts and they care about what their profit's doing, what their cash is doing.
So Andy, sort of again, so obviously we know the seasonality is a big thing, and probably around hospitality, retail to an extent, but certainly the weddings, the holidays. But what other things in general terms still put a business under pressure that affect, let's say, that affect their cash balances, but not necessarily affecting their P&L or their profit?
Classic, Paul, you know this, is VAT payments and corporation tax. Where people, I know Jackie said the professional business owner and just the business owner, where they don't realise and they think, oh yes, I've got a nice cash bank balance, I'll go on holiday this month, and then they spent the VAT money, and then it comes to the VAT payment and they have to put a payment plan into place. It's really just allocating, and I always say to clients, if they put 20% away for the VAT and maybe another 20% for corporation tax, just as a guide. And it's amazing how suddenly their behaviour changes because it's under a stricter regime. And the money is not as available as they thought it was. But those are the main ones. And again, critical is timing. Again, is whether you're paying your suppliers first before you're getting paid from your customers. That's another one that we see.
So if your debtor days, the time it takes you to get paid, are longer than how long it takes you to pay your customers, we're in that negative cash cycle, and it's how do we... And sometimes you can trade out of that. Because obviously you are profitable, but a lot of the time that just manifests itself and continues to go. And one of the things we've seen that, and I think it's more as people expand, is funding. And whilst the funding puts the money in the bank and they've bought that lovely piece of machinery, what they then forget is that I'm still profitable, but actually now I've got a capital repayment. I've got to fund a loan that's coming out of cash, but not coming out of profit. Yeah. And that's the biggest one we see people that fail is solely around, they've forgotten that the financial commitment to service debt doesn't come out of profit, it comes out of cash.
Exactly.
And Paul, the other thing is employee.
Yeah.
You know, you got a new machine, you need somebody to run that machine, so therefore you need an additional employee, so your payroll costs go up and employers and etc.
That's it.
Yeah, and I think on very simple terms, especially if you're starting out business and you're quite new to business and this all sounds a bit like, oh gosh, I haven't even got much cash flow at the moment. I think you need to get into good habits.
Yeah.
And that's very much where I think nowadays when you get a business bank account, there are lots of business bank accounts that have the pots.
Yeah.
And just like Andy said, I would always be advocating put that 20% or more if if you're likely to make a profit.
Yeah.
You need to also save for your corp tax or your personal tax. Put that into a pot. It isn't your money.
Yeah.
I say that over and again. It isn't your money. You are holding it for HMRC. It belongs to them. So just put it straight away, separately. And also, very key, put some money into a pot that is your salary.
Yeah.
Because as a business owner, you should be paid. Yeah. And too many business owners, they spend on the machinery or the employees or whatever they do, or their marketing even, although not enough spend on marketing. But those people, they end up going, oh, I haven't been able to pay myself this month. That's wrong, because all that does is build up resentment for you with your business. And if you think of your business money as a tube of toothpaste, once the money's out, once the toothpaste's gone, you cannot put it back in. Yeah. It's gone. Yeah. But you know when you get to the end of the toothpaste, you can eke it out. That's what your operating cash, your current account for your business should be, so that you don't spend money that you don't have. Yeah. And for me, it's all about managing your own expectations. And back to that, don't look at the bank and go, I can buy that. I can go on holiday. Yeah. You know, and make sure you
understand
paid
what the
everybody
implications are
Absolutely
of those decisions, and lean on your trusted advisors, your accountant, your business coach to go, is this the right thing for me to do right now? Yeah. And as long as you get those answers, you can or you can't.
Definitely.
Because the thing is, Paul, PAYE and NI payments to HMRC, again, you know, people forget about those. And you're thinking, no, you have to pay
I was once part of a business that I went into to help digitise the business owner's accounts. It was all spreadsheets. And he was in a spot of bother because he'd remembered to pay the PAYE and employees' national insurance to the taxman. What he'd forgotten was he has an employer's liability. Correct. And all of a sudden that came out of his cash and he was like, I'm in trouble now. And
of course, for a lot of businesses now, there's also pension.
Yes.
Which that's another one that comes out.
It's all of these costs.
It's just having that. It's back to being a professional business owner, making sure that you've got all the facts before you make the decisions, and using insights, using your software, using your advisors to help you to make budgeting decisions.
I think it's just to make informed decisions. That's how we try and term it. I know Andy does the same. It's making an informed decision and a conscious decision. If you make that conscious decision, I'm not going to, or I'm going to, at least it's being done informed. Exactly. And I think that's really important.
Paul, I must admit, with Jacquie, agree with Jacquie, is with the challenger banks now, they've got what they call spaces.
Spaces pods. Yeah.
It's brilliant.
It is.
For me, myself as a small business, every time I get a receipt, 20% goes into that pot.
That's it.
So when it comes to VAT, no problem at all.
That's it.
Just getting that.
It's the good habit, isn't it? It's a
behaviour.
good habit.
Mm-hmm. Change behaviour. Yeah. So I think we know some of the good things we need to do. We understand the difference now between reading turnover and profit together. We understand that cash and profit are completely separate, albeit have a link. But what's the most common, I didn't realise that moment that you see with clients when you sit with them and look at their numbers? And I don't mind who.
I think mine is when they realise actually what it's costing them per unit, as I think you mentioned
economics.
it earlier. They don't know that. They don't. Most business owners, if you ask them on the street, what's your gross margin, they wouldn't have a clue.
Yeah.
And it's a really, really important number because it can be too high, it can be too low.
Yeah.
If it's too high, that's probably you're not giving the value that you should be giving, and you're going to lose your customers because they're going to get fed up because you're overcharging them. Equally, if it's too low, you're not getting the value you
become that
deserve.
busy fool that
you become that busy
we dealt
fool.
with in a previous that we'll deal with in a later podcast.
Yes. And I think it's really important knowing your gross margin, and when you do, that really opens people's eyes to what their potential is, and that's where it feeds into your pricing. And that's once we know where the gross margin is, that's where we look at the pricing and actually work out. Well, you know what? You might be busy, you might have a full diary, but actually, if you charged 10% more, you might lose a few clients, but you'd be doing less work. And, that's when people start to actually get a bit of time back and enjoy their business again, really.
Yeah. And Andy, anything else or any other I didn't realise that moments?
Gross margin is very important, but just be careful because sometimes you may have a low gross margin, but very profitable because it's a volume-driven business.
That's true.
So just be careful on the type of business you're in. Because again, I've got a client that's online retail.
Yeah.
Margins are small, but the volume is high.
Absolutely.
Therefore,
Brilliant.
But it is an important one to consider.
So there's lots of positives that we can take. There's lots of things that actually we're now aware of, but there are always those skeletons in the closet. And what are our accounts, whether that is, and I'm not a massive fan of talking about accounts because I think it should all be about looking forwards, but what are our historical accounts trying to warn us about that we then should act upon moving forwards?
Can I just stop? Well, I'm going to slightly throw this out.
Okay.
Really, with your business that you're in, with cloud accounting, it's a godsend really for a lot of people. I know initially when they look at it, they're going, "Oh, this is terrible, this is awful." But once they get used to it, it's amazing how much and better decision making they make.
Yeah, it becomes a real-time tool, not a historical tool.
If you got something that's on a monthly or quarterly basis, you can then look, because we all know come April, minimum wage is going up. We got the employers NI, that's still at 15%.
Yeah.
We're looking at energy costs now. Yesterday I was at a client and their standing charge per day has doubled. Because of various other factors that come in that you don't, but with having sort of figures in front of you, you can make more informed decisions. And that's the key. Yeah.
But let's assume people haven't quite made it into that digital sphere yet, and we're still working off spreadsheets with that once a year accountant meeting, let's say, and Andy, you and I know will be completely different. But what kind of things do we see in the accounts that are that little warning that perhaps don't jump out at us, but we should be aware of? Now, that can be in your profit and loss, it can be in your balance sheet, but in our accounts overall, what are those little things that we need to go, oh, hang on a minute, that's lower than it was, or that's higher than it was? What are the type of things that kick out?
I think one of the things that I look at, certainly when businesses are in that sort of middle, when they're in that growth, in their growth thing, a lot of business owners think they suddenly need an admin and a marketing and a this and a that. And actually, looking at your staff costs compared to your turnover is really important, because for you to be able to, I'm going to use the word afford, but to be able to get the best from somebody in the business, you've got to remember that it's not just their wage. They've got to be producing a bigger revenue than their wage. So I always worry when I see a really high salary compared to turnover ratio. I use an example of a catering business that I've been working with for quite a while, and when we really dug down into her spreadsheets, what she discovered was that a lot of her outside events were being overstaffed by a front of house manager who wanted the day to go nicely.
Yeah.
And that's great because it's great for the customer, but actually for the bottom line, it's not great.
Yeah.
Because for every extra waitress or waiter or barista or mixologist or whatever it is that you take, you've got their, not just their wage, as Andy said, you've got their NI, you've got their pension, you've got their
uniform.
Exactly.
Yeah.
And what we discovered is that she is basically hemorrhaging money on her staff.
Yeah.
So for me, one of the things that I look for in a growing business is that business owner, whilst you've very much got to be taking on staff to grow, it's got to be at the right time, and you've got to then fill your capacity before you take the next one on.
Yeah.
And that's why I often include the cost of salaries for staff that are there for part of the delivery, almost like I'm going to call it above the line. They're a cost of sale. Whereas if you take on admin people, they're not, and you need to be sure that you can afford them. So a bit of a roundabout way, but salaries is one that creeps up.
Yeah.
I think.
Classic Jackie is your business development manager.
Yeah.
You know that's going to come in at a big cost. You're not going to see any return maybe for 3 to 6 months.
Exactly.
And it's just having that, your figures and your cash, and that you can comfortably.
And I think that comes back to what Jackie said earlier about having 3 to 6 months worth of your fixed cost base in the bank.
Correct.
So that when you do take that member of staff on, I know I can afford them whilst we're ramping up again.
Exactly,
because invariably you can't ramp, you can't scale till I've got the staff to be able to allow me to scale. So that 3 to 6 months in the bank, and we looked at that when we grew, was actually, can I make sure I've got 6 months of their salary in the bank while we then go and find the work.
And that's where the insights and the budgeting is really, really important, isn't it?
It's
to
those
make sure
what
that
ifs.
you make. Yeah, it is making sure that you have that capacity to pay them whilst they're bedding in and giving you an ROI, really.
I think, Paul, this is great if you've got cloud software.
Yeah.
If you're on Excel and you're reporting from the past, things have been done that you can't really correct.
That's it.
So
It's too late.
It's with having your figures you can make better judgments and decisions.
So as part of that making decisions and judgments, why do trends matter when making decisions over just one bad month?
Oh, blimey. Again, seasonality is one.
Yeah.
And just out of interest, Paul, I have my engineering client, and I can tell by the turnover for the month whether that's going to be a profit or a loss straight away. I'll just know. Yeah. They need to hit a particular level of turnover. If they don't, it's a loss for the month. And I think now with the geopolitical situation we're in at the moment, costs are going to be a big factor, and people have to be, or business people have to be in the position to be prepared to say, we need to increase our prices, because a lot of us will just leave us. We've got costs coming up, and therefore our profitability is going down, and most likely we're hemorrhaging cash that we don't need.
Yeah. So kind of, I guess, where I think the viewers would probably want to understand is, at what point do I need to worry that there's a trend? Because 1 month in isolation, you can normally justify and go, oh, it's this or it's that. But at what point do you, as an accountant, and obviously Jackie, you work with businesses probably a little bit closer in terms of the day-to-day, at what point do we go, we now need to address this because it's becoming a bigger problem than just a one-off occasion?
I think that's a good question, because there's all different types of trends, aren't there? And that's why most of the clients I work with have some level of a very simplistic scorecard, which they can immediately get those alerts before they've even looked at the bank. And that, if they know that if they're not getting enough inquiries in, for example, 3 weeks down the line, that means they're going to be down on sales. So what they can do is ramp up their marketing spend, or make sure they're going back to some old customers and revitalising them. So it's all about looking for things before they're there. And that's why, as a business owner, that's the stuff you should be doing when you're working on your business. Not reacting, but looking ahead, looking for those trends almost before they happen. And that's why, actually, I mean, as you've already alluded to, historical accounts are of no use in that whatsoever, really. They might tell you that 2019 was better than 2018, but it wasn't as good as 2023. But that doesn't matter. It's gone. It's past. I still have people saying, oh, but it was better before COVID. Yeah, I'm sure it was, but it's not relevant. What's relevant is the here and now and what we have to deal with, the here and now, but also what's coming, and we need to be forward thinking. And that's where, and I think that your scorecard, you need to be looking at every week. How many inquiries we had in? How many calls have we made? How many people have we managed to speak to?
And I think, sorry, Jackie, and I think just again for those that have joined us, a scorecard doesn't necessarily have to be financials.
No, it doesn't.
Because a lot of what you've said are actually things that are pre a financial transaction, but actually are going to deliver us a financial transaction if we get it right.
Yeah, absolutely right. And actually, to see them that early, you can predict it, can't you? So if you're a wedding business and January's dead for you, well, you know you're in trouble. Because January is when most businesses in the wedding industry take 30% of their bookings. So if you've had a poor January, you know absolutely you've got to do a Valentine's campaign, and you need to up the ante, or you need to go back to all those people who have downloaded your brochure or made an inquiry and come back to them, and it might be giving them an offering that, you know, an offer they can't refuse or whatever it is, but you taking that very proactive approach to make sure you convert more. Because if you don't and you just sit there going, oh dear, it's the economy, well, we make our own destiny.
Someone once said to me, the best time to get your next client is while you are busy, not when you're empty, because you
100%.
end up with this kind of
famine and feast.
Feast and famine. Yeah, exactly. So we're talking about now we need to do a bit of forward planning, and we need to be thinking about actually where are we at in our whole thing, whether you've got formal budgets, and pardon the expression here, back of a fag packet budgets, it doesn't matter, but how far ahead realistically should a business owner be looking to plan?
Oh, that's an interesting one, and I know there's a lot of debate about this.
Hence, it's chucked out there.
For me, when I sit down with somebody for the first time, I always say, I want you to visualise where you're going to be in 5 years, and let's work back from that. Because 5 years is not so far that it's unthinkable, but it's far enough that you've got time. And I will say, you probably won't end up in that place, but it doesn't matter. Because, and all of us change as we go along. But 5 years is your starting point. That doesn't mean you do that in absolute detail.
No.
But that goal, that key driver of where you want to be in 5 years, whether that's a new house or a business that's chucking off X amount of profit for you to do whatever you want to do, that's your starting point. And then you work yourself backwards. And then actually the next 12 months is probably where you really need to get the detail. And the next 3 months, you should know absolutely inside out, really, what you're going to do in terms of your marketing, what you're going to do in terms of your spending, whether you're going to be employing anybody in the next 3 months. You should never be thinking, I need to employ today. You should have always had that. And if you think all your staff are saying, well, no, you should always be keeping your eye open. Because if the right person comes along, you need to employ them anyway.
It's like your 1, 3, and 5. You know, your 1 year. 5 is where you want to go. 1 year is what you're definitely planning to do. And 3 is your review where you stand, where you are.
And I think I think if you can start to get those, let's call them forecasting budgets. I'm not a fan of the word budgets, but forecasts. I think what that allows you to then do, and I know that certainly an accountant should be doing this with their clients, is you end up with almost a 12-month forecast, because that's the real measurable stuff. And behind that, and we absolutely do this, we then work with a rolling 3-month cash flow. Because I think a 12-month cash flow is too far, but a 3-month cash flow behind a 12-month forecast suddenly mean we can look at the two side by side, and to go back to our point that we said earlier, actually cash and profit suddenly then have a tangible link that's visual. And yes, with those forecasts, and I know you've both had these conversations, you can afford that member of staff, you can afford to buy that next vehicle, you can afford to extract some money out of the business and go on and have a nice holiday. All of that gives us those insights. And then how often then, so we talk about forecasts, we talk about budgets, management accounts, how often should a business owner be reviewing their numbers to stay in control and not get overwhelmed? Because I think that sometimes is people don't want to look at the numbers because it's just too overwhelming. So how often should they be looking at them to stay and feel they've got control but not get overwhelmed?
Personally, I think I would be looking every week. I wouldn't be looking every day, but I'd be looking every week.
Yep.
But that's because I'm looking at my scorecard,
Yeah.
which is telling me the inquiries are coming in. Yep. I've got the phone calls being made. Yep.
Yep.
I've got some sales. Yep. I'm good. I could go and look at my accounts.
Yeah.
But equally, if they're red, I know I need to look at my accounts
Yes.
because I might need to adjust something.
Yeah.
Because if the money's not coming in, something else will have to
Yeah.
give. So I think actually we're back to the professional business owner. You got to put your big boy or girl pants on and you've got to deal with it, because running a business isn't easy.
Yeah.
But it's easier if you can react to something,
Yeah.
if you need to react to it. If you leave it and you put your head in the sand, all you're doing is storing up trouble.
Yeah.
So I don't know. That might not be the accountant speak,
No.
but as a
No,
business
no,
owner,
no.
I'm saying
Yeah.
I think
weekly.
a week is too much. I think I can understand as a business owner.
Yeah.
As an accountant, I think minimum quarterly, but monthly would be preferential.
Yeah. So for the business owner to sit with the accountant, yeah.
Yeah.
But as a business owner, just keeping a track of where
Oh
you
no,
are.
they can do that weekly.
Yeah.
Because I know, again, with one of my clients, they have an order book, and they
Yeah.
know exactly where they stand.
Exactly
so
right.
they say, well, we're struggling now for next month. We need to get.
Yeah.
That's it.
on
And
the phone,
I
etc.
do. I think there's
It
very
depends on the
much.
metrics you're looking at.
Of course it is.
I was about
yeah.
to say, for me, there's two parts.
Yeah.
There's two parts of this. I would use let's call it the scorecard, that pre-financial transaction
Yes.
piece. That's where, and
That's
I
the
do
weekly
look
bit.
at weekly.
Yeah.
And then because you've got lots of things that are monthly costs, I think if you look at your accounts weekly, it can give you a slightly false
Skewed view.
picture. So absolutely scorecard, and I'm one of those. I've got the metrics of how many leads have I got, what am I working on, what does that financially look like when I know I'm going to finish it, and then actually when it finishes and it hits your account, I then have got my true cost against
right,
that.
yeah.
So for me, I think there's that split. So we now know what we're looking at, and we've got all of those bits, and hopefully people have been a little bit informed now about what and how we should be dealing with those numbers. But actually, what do I do with those numbers? How do I use those to make the right decisions in my business, assuming that I don't have a proactive Jacquie or Andy supporting my business? How can they use those numbers themselves to make key informed decisions around things like hiring, pricing, cutting costs? Or
I'm going to tell you what you shouldn't do. You shouldn't be chat GPTing it. All we're hearing at the moment is, I chucked it in chat GPT, I chucked it. And I just think, just for the record, chat GPT is brilliant, but your accounts are something where you need somebody who understands and you need to have proper understanding.
And let's just, in the fairness, just say that there are other AI tools other
yes,
than
Gemini.
ChatGPT. We are not endorsing ChatGPT by any stretch.
No, but yeah, using AI,
Yeah.
there are some great AI tools, but actually, as a business owner, you've got to understand your business as a whole, a holistic view of your business, which is about the numbers. It's also about the staff. It's also about the other things. But I've gone off there. Sorry. Paul.
No.
Jacquie, what you're alluding to is really for you and I, is we have to understand our client. If we don't know our client, we can't give the beneficial advice that we can help them get through.
Absolutely. And I just want to pick up on two, because I think there's lots of businesses that look to scale. So if we deal with these individually, but collectively, they kind of will have the same decision making. If I'm looking to increase my revenue, what numbers technically, and I think we've kind of put little bits in during, but if we can bring it together, what numbers should we be looking at when it comes to setting our prices in the first instance?
Well, if you ask Stephen Bartlett that question, I know he's
Wow.
not here, but I'll be his mouthpiece for you. Stephen Bartlett was asked that question when I saw him last summer, and he said, you put them up till they laugh.
Yeah.
Because the truth of the matter is you have to understand your own value. You have to understand the costs. And actually, if you're doing the right thing and you are of value, people will pay for you because a price is just a number.
Yeah.
What people mistake the cost as value, and it's different. So, for example, Paul, I would pay probably £500 to go and see Robbie Williams. I bet you wouldn't. I might be wrong. You might be a closet Robbie Williams fan.
No, probably not.
No,
Probably not.
Somebody else might go and spend £500 to go and watch the rugby at Twickenham.
Yeah.
I would probably not go to the end of the road to watch the rugby.
Yeah.
It's about value.
Yes.
So your pricing is all about your relationship and your value proposition.
Yeah.
So I would say if you're looking to increase your revenue, putting your prices up is one of the quickest and easiest ways, provided you are giving the value.
Yeah, absolutely.
Obviously, if you just put your prices up and go, oh, everybody's doing it, I'll just do it.
Yeah.
You've got to be transparent about why, I think.
Yeah.
I think Jackie as well is your client. Because we all know we got clients that are just price sensitive, and we know they're not going to last long. And really is just go for the value that you perceive your value. I know. I was at Fab last week with you, Paul, and there was a lady there, and her basic tax return is £400.
Yeah.
And she said, "That's the value I put. If people don't like it, that is it.
Yeah.
I'm happy."
It is
because they don't appreciate what goes into a tax return.
It is, and I think that pricing piece and Jackie, and it wasn't pre-engineered. That's what I was after. Is price it to the point that people start to say no. Because if every time you price, somebody says yes, you are too cheap.
Absolutely right.
Yeah.
Genuinely, and then it's that busy fall again that
and
we'll
I
explore.
do challenge my clients. Say, what would happen if you doubled your prices?
Yeah.
Well, I'd lose half my customers. Good.
Fine.
Yeah.
Half your time back, haven't you? You know.
It is.
I mean,
it is.
that may be extreme, but there certainly is room.
Yeah.
If you're giving genuine value to your customers, that you genuinely can.
And I think, Jackie, you find most likely with the clients that you're dealing with and their clients, their clients are prepared to pay because they know of the value that you can bring.
Yeah, I put my hand up when Andy's a great introducer for us, and I know, Jackie, you've done the same. One of my first gambits out of the blocks is we're not the cheapest. You will find someone cheaper than us, and if it's cost that you're after, actually it's probably not worth carrying on this conversation. One, I don't want to waste that time because I can be dealing with that elsewhere. But two, I'll know straight away whether it's value they're after or just price.
Absolutely. One of my clients sells EV chargers, and he's £100. It's only £100, but it's he charges £1,000. No, £100 more than your average. Sorry.
I was going to say that's good value.
No, it would be good value. No. So he charges £1,000, where most people are pitching around £800, £900. And he said, "How can I protect it?" I said, "You don't protect it. You go out and tell them. You say, we are £100 more than our competitors because this, and this, because you've got reasons." And they go, "Okay."
Yep.
You know, Jackie, it's funny. When I started 6 years ago, I had a phone call from this lady complaining about her accountant, and I said, "Look, that's something between you and your accountant. I can't interfere." And she asked a few questions, and I said to her, "Look, you know, before we go down the pricing route, I'm going to be more expensive than your current accountant." And we chatted, and at the end of the conversation, she said, "Do you know, I've learnt so much more in the 15-minute conversation we had."
Yeah.
And I said, "But don't forget, I am going to be more expensive because of that."
Yeah.
And she sent her the quote, and she rejected it and rang me up, and I said, "I told you.
Yeah.
You know, you will get the information that you need, but the current accountant is at that value because he's not giving you the information."
It's great. I mean, we and to be fair, I know Jackie has done this exact piece. We talk about a triangle: good, cheap, and fast. If you want cheap, they're not going to be good, and they're probably not going to be fast. If you want good and fast, they won't be cheap, and so on and so forth. You can't have all three. It's impossible. And as long as people understand that, you tend to then get them on.
Well, I've got a client, and again, it's the unit value of the product that is of real interest. So they import from India because it's at a low cost. But if they want something quick and of good quality, they will charge because they go to a different supplier, knowing that supplier will. Yeah. And that's
We'll deliver,
you pay what you get.
Yeah,
Exactly
that's it.
right.
So all of this sort of stuff, and it was alluded to earlier about how cloud has changed the way, let's just call us all advisors, can support clients. You both have, I mean, I know, Andy, you've been 100% cloud from the day you started, and your clients need to be in the cloud for you to work with them. And Jackie, you've made that transition over time. How do you find the cloud tools have made advice and being able to empower a client easier?
Well, I think when it's in the cloud, the great thing is when I'm working with a client is we can look at stuff in real time, like you said before. Real time matters, because we're looking at a business that's running right now, and a business owner needs help. Yes, we need to look back at what's happened and look for trends, but also we need to know what's going on right now in the business. So it's been
has it changed the way you now support clients because you've got that?
It has, because what we do now when we look at the 7 key numbers together, which is, I'm going to be honest, is largely about the number of customers, your pricing, and that sort of thing, because that's the bit I deal with the most. But we start with the accounts, and we do get the historical data right up. I literally start from today and go back 12 months and say, this is what's happened. Now this is history, but what we can do from here is look at this, and then my next column for the 7 key numbers, we've got a little percentage change. So we can look what happens if we add 20% to the price or 10% to the price, and what happens to the profit line at the base where they made, say, £5,000. Oh, if we just change the number of customers, or we just change the profit, or if we just decrease the costs, look what happens to your profit. And it really, that's when the scales come off people's eyes, and they go, oh my word, okay, so I've only got to put it up by £10 a month, and I'm going to get that.
And the thing is, Jackie, as you rightly say, people are scared of putting up prices because of loss of clients. But you find that you put up your price, you are not going to lose the number of clients that you expect.
No, absolutely
it's a lot lower.
And the other bit which is really good on that piece, when we pull that out, is we actually, for the first time, most people see what their break even is. And most people can't tell you what their break even is.
And to be fair, that for us is where the cloud tech really helps, because that break even will move from month to month, and based on staff, to try and produce a break even on historical data is nigh on impossible. And Andy, is there anything that you've used cloud with from an accounting perspective?
It's just, I'm going to bring it up to date with Making Tax Digital. And I was with a firm of accountants the other day, and they started to implement this earlier, and they had initial resistance to this, but once the clients got it, totally transformed them. They then saw that yes, spreadsheets are useful, but they don't give you an up-to-date figure. You have to collate it and everything. Where now, as Jackie said, you got the numbers in front and you can make decisions. And what is nice is, again, with cloud, you can do cash flows for 3 months. So if you're looking and saying, right, I'm thinking of buying a van or a machine, you can factor that in and see how that affects the cash flow.
And on top of that, if you are making a great profit, you can start to put money into your pension, which obviously it saves you your tax. Or you can, you can do all sorts of things, but you've got the knowledge, because the knowledge is the power to give you choice, and that's what you need.
It's the figures, because really it's looking at expenditure, because we know now that heat and light's going to be a major issue coming up. We know rates are going to be another issue coming up. And it's just being able to plan for that and see how that affects.
I think what's coming out of this is actually, when you put things into that real-time environment, you suddenly get far more tangible data in a more informative and actionable way, because it's when we go back to those trends we spoke about, instead of waiting for 3, 6, or in some cases 12 months before you've seen your accountant to be able to react. It's there, it's instant, and that trend that we'd normally take 6 months to spot, we're now spotting it in advance.
And the beauty of Xero, isn't it, is that
Yeah.
you don't need to fully understand Xero. There are really clear dashboards
Yeah.
and reports you can pull off that give you as a business owner as much as you need
Yeah.
on that month-to-month thing.
Yeah.
And then when you have your quarterly or your monthly meeting with your accountant, they can put more meat on the bones. But you can see, in an instant, you can see where you are and whether you need to be doing something different.
Yeah. No, absolutely. So I think to round up episode 1 of series 2 or season 2, let's go a bit Americanized. Give the viewers and the listeners one nugget around why they need to understand what their numbers are telling them. Just one nugget each, so they can go away with 2, because we're generous as a podcast like that.
Paul, going back to my clients, I think with the way the economy is your pricing.
Yeah.
And I think your turnover will be affected, and it's getting that to make sure you're profitable enough.
Yep.
Because
so that insight into
we
pricing
know,
is the nugget.
People are happy to accept some of the increase in cost, but not reflect it on the top line.
Yep. Perfect.
And for me, I want them to remember the tube of toothpaste.
Yeah.
Because once it's squeezed out, you can't get it back. So don't spend what you haven't got.
Yeah.
Put the money in the pots and make sure that you are working off a true reflection of what you've got as your money, your cash, not what you owe to HMRC, not what you owe to yourself.
Yeah.
So that's
Fabulous. That's absolutely brilliant. And that brings us to the end of the first episode of season 2, Giving You More Than Numbers. A huge thanks to Andy and Jacquie for breaking it down in plain English. What's the one number you're going to track from now on and hold yourself to account? If this episode has helped you, like, subscribe and share and leave a review. It really helps other business owners find us and learn from your insights. Thanks for listening, and we'll see you next time on Giving You More Than Numbers.